we're going to talk about mortgage options on multifamily homes for both investors and owner-occupied buyers. This has been a growing topic, and something that a lot of people that were traditionally, let's talk about owner-occupieds first, right? So people that were traditionally going in and buying single-family homes, all of a sudden they were like, hey, you know what? I can get maybe a better investment or a lower payment, and maybe more house, or it just makes more sense financially, or I'm priced out of the single-family market. I could go get a multifamily and purchase that, and that's been really good for some of our buyers. I'm curious to hear your end of it on the mortgage options for that type of buyer.
Sure. So we'll start with obviously owner occupied. I mean, in particular, this market today, there are a lot of people that, first-time home buyers that explore the 2-family, 3-family, 4-family option. As you mentioned, it definitely gives you a lower monthly payment with the rental income. It allows you more buying power as well. So I would say, the most common for owner-occupied multifamily homes, the most common mortgage product is probably FHA, Federal Housing Authority, and most people are familiar with this. This is a 3.5% down program, 1 to 4 unit owner-occupied. And, you can use rental income from day one, either with lease agreements in place or, with what it's going to be with future, fair market rent, whatever it may be. So 3.5% down, very standard. I would say most common for first-time home buyers who are buying, multifamily houses. Secondly, what I think is even more important than ever is the conventional option. Years past, there was always this stigma where, you're buying a multifamily home or investment property. I got to put down 20, 25%. And that was the case years back. But about a year ago, the government got involved and said, you know what? We're going to find a way to get conventional buyers into multifamily homes with less money down. So now there's an option where 5% down is allowed on owner-occupied 1 to 4 unit properties with conventional financing. And why is that huge? Well, Emil, you can attest to this. 2 reasons, I think. One, arguably conventional buyers are higher in the priority list. When you're accepting an offer as a listing agent, you see conventional and maybe an FHA. More often than not, if things are similar, you might consider the conventional because of the guidelines being a little more loose with the appraisal requirements. But most importantly, on 3 and 4 unit properties, is something called the self-sufficiency test. And what's happening is on FHA properties, you need to pass this test, meaning they take whatever rent is for, let's say, a 3 unit property, and let's say easy math, $1,500 per unit, times 3 is $4,500. Now, they use 75% of that number FHA, and that number there, in this case, let's say it's, $3,500, wherever it may be, the mortgage payment can't be more than that. So even if you qualify on paper, if that test fails, which does happen sometimes, the financing falls through. But with conventional, on the other hand, with a 5% down, that test does not apply. So you can see instances where you're representing your sellers and you're accepting offers. Well, conventional would be more preferred, and it's a stronger offer in general. So that's why I'm saying conventional and FHA are the most common two for owner-occupied. Lastly would be someone who's maybe outside the box, meaning self-employed, or maybe someone that, has businesses, doesn't show a ton of income. There's portfolio options out there as well for owner-occupied that require, those are 20% down. So again, when I sit down with someone owner-occupied, I go over FHA, conventional, and then portfolio options for owner-occupied.
So investors that want to purchase multifamily homes, that's 2 to 4 units. That's where we want to talk about, right? We're not talking about commercial. Right.
Correct. 2 to 4 unit properties. In a nutshell, FHA is not an option because it has to be owner occupied. VA, same thing. It's, it really has to be conventional, the 101 conventional, which in 2 to 4 unit properties requires anywhere from 20 to 25% down, depending on their down payment, their credit score and their debt to income ratio. Or we can go with the DSCR loan, the portfolio route. And this is a great program. DSCR is a debt service coverage ratio loan. And what this is a great program for investors. It can be repeat investors where all we look at, let's give an example here. Let's say a 3 unit property, let's just throw out maybe in Providence. And let's just say rent is, $2,000 per unit. So we have $2,000 per unit times 3 units, that's $6,000 a month. As long as the new mortgage payment, principal, interest, taxes, and insurance is less than that number, you're approved. There's no income verification, no W-2, no pay stub. We look at down payment being at least 20%, as well as your credit score being ideally 660 or higher. Even 640 in some cases, I can make this work. And the great part is whatever debt you have, it's irrelevant. All we care about is that specific property. The rental income covers the mortgage. You could have numerous properties on your tax return, We don't care about that. And each property we look at individually. So you can do this numerous times, 5, 6, 7 times. We'll give you a $3-4 million portfolio, and you can do this repeat. And at the end of the day, rates might be a hair higher, let's say 0.5% to 1%, but there's no income. How do you beat that? I mean, it's a no-doc loan. We can close in 21 to 28 days, all 50 states.